newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie, filling in for Francine Lacqua this Monday, joining you from London. The conflict between Israel and Iran is now into its fourth day with no sign of it ending. An Israeli strike in Tehran has killed another key military official. Well, Iran has fired several waves of drones and missiles over the last 24 hours. Loud explosions have been heard over Tel Aviv as missiles were intercepted by Israel's defense system. The Israeli military says 8 Iranian drones were intercepted overnight. In Iran, Israeli strikes have targeted nuclear facilities, a natural gas plant and senior military figures. Let's get more from Bloomberg's Jumana Pasecci in Dubai. Jumana, are we looking at this stage at a protracted conflict, or are we starting to see the closing chapters of this standoff between Israel and Iran?
Well, Tom, we are entering to a fourth day of conflict with no signs really of de-escalation. The Israel military saying this morning that since the conflict started, over 370 missiles and 100 drones have been fired from Iran into central parts of Israel, northern Israel. Most of those missiles have been intercepted, but there was an attack once again on Tel Aviv this morning, and several of those missiles were actually able to break through Israel's air defense system. The death toll now counting in Israel to as high as 23, with dozens other injured. As for on the Iranian side, the airstrikes continue. Israel continues to target those nuclear sites as well. Serious damage at the Isfahan uranium conversion site, key to part of the nuclear program, alongside those military targets and some of those energy sites as well, with over the weekend a fire alighting at one of the biggest gas fields in the world. Now, Iran isn't a big exporter of gas, but it is notable that the scope of these attacks is also broadened to include energy infrastructure as well. The death toll in Iran now counting to at least 224 people, according to the Iranian Health Ministry, and that includes senior Revolutionary Guard commanders alongside some of those nuclear scientists. So at this point, the war of words continues as well. The Israeli Prime Minister vowing to continue against the existential threat from Iran, as he calls it. The Ayatollah also saying in kind that they will strike back very harshly. And also of note, Tom, the 6th round of those U.S.-Iran nuclear talks, which were scheduled to take place yesterday, were cancelled indefinitely.
Yeah, and we heard from Trump, of course, over the weekend, the US president saying that he believes the conflict can be resolved diplomatically, but perhaps not right away. Let's take a listen.
Mr. President, can you give us a sense of what you're doing to try to de-escalate the situation between Iran and Israel?
Well, I hope there's going to be a deal. I think it's time for a deal, and we'll see what happens. But sometimes they have to fight it out, but we're going to see what happens. I think there's a good chance there'll be a deal.
So, Jumana, we heard, of course, from the US president. Those were his comments. Do we know if there are any lines, diplomatic channels at all, open between Israel and Iran, either via third parties or via the US?
There's certainly an attempt to restart the diplomatic channels. There were reports over the weekend that Iran reached out to Qatar and to Oman to help restart those talks. The U.S. president himself saying there that he would like to see a deal reached. He used the word deal between Iran and Israel. But of course, at the heart of this is whether the U.S. themselves want to get entangled in military conflict. At this point, I should note that the reason perhaps markets are so subdued today is because what we've seen is so far bilateral attacks between Iran and Israel. It hasn't broadened out into broader regional conflict. Iran haven't gone as far as looking to target or actually executing on targeting U.S. assets or even disrupting the Strait of Hormuz. So maybe this morning what we're seeing is a bit of a relief because so far it certainly appeared to be contained. But from this point onwards, we will have to see more efforts on the diplomatic front and also the U.S. actually exercising the leverage that they have in the region to bring down the temperature and perhaps push forward with that nuclear deal. Ultimately, the main objective that Israel has set out in this war, in the strikes that they conducted on Thursday, is to stop Iran from developing a nuclear weapon. Perhaps now is the opportunity for the U.S. to push more forcefully in terms of getting Iran to the negotiating table and enforcing some of those red lines that had been discussed in the run-up to these attacks.
OK, Horizons Middle East and Africa anchor Giulia Pisenci with the latest, of course, in that conflict. We'll get another perspective, or at least another angle to this story now, because Bloomberg understands the US president blocked an Israeli plan to kill Iran's supreme leader. We'll bring in Dan Williams from our Jerusalem bureau, who's in London because he can't get back to Jerusalem because, of course, the skies over Israel are currently closed. Dan, this is a shift in strategy and potentially a significant one. Israel now targeting senior political leadership in Iran and saying that regime change is something they're aiming for.
Yes, but it's worth noting that formally, at least, Israel has denied those reports. It says, as of a few hours ago, when the national security advisor of the country was interviewed on two major radio stations, that type of extreme regime change movement, at least in terms of an initiated Israeli assault specific on the supreme leader, is not in the cards, is not part of the planning. The line appears to be that Israel is moving against military assets, regime assets, and if that effectuates a downfall of a regime, potentially in sync with some kind of groundswell of movement within Iran among people opposed to the regime, Israel would certainly welcome that. OK, so they'd welcome it. Maybe we've got some mixed messaging then from senior officials, the Ministry of Defense in Israel, one of the senior government officials there, suggesting that regime change was a priority. But now they've moderated the language around that, which is important. So thank you for clarifying that, Dan. On some of the objectives that we know are front and centre for this Israeli government, one is the degradation, of course, of the nuclear facilities and capabilities of Iran. And the second, possibly, is the secondary consequence in terms of the regime itself. On the nuclear facilities, how much damage have they done so far? And ultimately, will they need the US to participate to take out particularly Fordow and the nuclear facilities there? That's an excellent question. As Giulia pointed out, apparently major damage has been done to that conversion facility at Isfahan. A nuclear weapons program, if that's what Iran has, it denies having such a program, would require that, and they don't appear to have a replacement facility. The Natanz uranium enrichment site, that's the major uranium enrichment site that they've had. According to Israel, the damage there is big. The question is if it's irrevocable. There is a site that is so far untouched, Fordow, dug into a mountain expressly in order to withstand such an attack. It would appear that would require American firepower. B-2 bombers with 30,000-pound bombs. Israel doesn't have those planes and has no way of delivering such bombs. It has fighter bombers, the biggest of which is an F-15. But in theory, and I stress in theory, if they have dominance of the Israeli skies, they could continue flying back and forth, dropping bomb upon bomb into the same crater until they manage to burrow into the depths of that mountain. OK, Bloomberg's Dan Williams, thank you very much indeed on the Israeli strategy at this point, as the conflict, of course, continues. Let's get a focus on the market reaction right now. A little bit mixed, of course, and in the session, question marks as to whether or not this is a market becoming a little bit more desensitized to that conflict and the geopolitical risk around the Middle East. You're actually seeing oil prices a little softer at the session, and of course European stocks are up. Just 0.2%. US futures also flagged and called higher as well. Let's bring in from Morgan Stanley senior global economist Rajeev Sibal, who's been waiting patiently around the desk. Rajeev, thank you for your time. I want to start on inflation expectations as you look at this economy in the context of these renewed Middle East tensions and the higher oil price story. Yes, prices are moderating somewhat today, but they haven't, of course, paired the gains that we saw that came through on Friday. Have you adjusted your inflation expectations for this global economy?
So I think the impact of inflation really depends on which economy you're looking at. In the United States in particular, actually, one of the big surprises is that oil movement doesn't affect core inflation as much as many people would expect. And so for us, taking that in combination with the fact that at $75, we're kind of back to the levels we were in March and at the beginning of the year. So when you're looking at this on a year-on-year basis, we don't really think things are going to move the needle that much for the Federal Reserve. Now, clearly in Europe and other regions, there's a lot more sensitivity to oil, so we keep an eye on the volatility. But for now in the U.S., we called our call, and we believe that, nothing's really going to change at these price levels. Obviously, if we get a lot more volatility, we'll react and adjust.
OK, on your call around the Fed, and you came out earlier in the year with a counter-consensus call that the Fed would not cut again in 2025. They would not be cutting in 25, in fact. And markets are still pricing in close to 2 cuts. And we'll see how that adjusts following Wednesday in the press conference from Jay Powell and the adjustments to the forecast as well. But you hold that view, no cuts in 2025. How does that tie you in and lead you into 2026 then? And just give us the rationale that underpins that call.
Sure. When we made the call to move to no cuts in 2025, I think the futures were expecting 100 basis points of cuts this year. We're now down to 50, so we feel like consensus has come into our call.
They're catching up with you.
Well, the issue for us is that on our models, we see that there's a time lag between the imposition of tariffs and the actual readout of inflation. And we believe that's about 4 or 5 months. And so as inflation is rising, we just think it'll be difficult for the Federal Reserve to really react. And so we don't really see the inflation so much deeper in Q3 topping out. And it's after that we can start having the conversation. But there's a whole mix of policies that are going on in the U.S. that are really changing not only the inflation side, but the labor market side, which is the other side of the Fed's dual mandate. And so when you take those in combination, that's why we had to take out our calls for cuts.
Do you price in a more dovish Fed on change at the top of the Federal Reserve come next year?
So independent of the change of the Fed, I think one of the biggest points we were trying to make with our call by taking out cuts in 2025 was we just moved them to 2026.
Right.
So whoever comes in next year, they're going to be facing a very different inflation and growth situation, and we think that leads to more aggressive cuts in 2026.
What does all of this do to the trajectory for the US dollar?
So this has been a tough one. I mean, obviously the dollar weakness is signaling kind of some of the forward rate cuts, and we've had a pause for a very brief moment of time a couple of weeks ago, but then the dollar started getting weaker again. So, that's a signal perhaps of asset outflow, people looking for a new domicile, gold, euro, other assets for central banks to hold their currencies in. So, for us, we do see dollar continuing to weaken as we look forward to these rate cuts.
And specifically, is that because the outflow story is counteracting the higher rates, or at least rates higher for longer?
I think it's a combination of factors. I mean, we have to really remember that the dollar ran really far ahead of Trump's coming into office and then at the beginning of the year. And so in many ways, markets had overpriced the dollar. And so the beginning part of that move was probably somewhat of a correction. Now that we're going forward, it's the weaker growth outlook and the weaker inflation outlook in 2026 that we argue is going to continue to bring the dollar lower.
The other big central bank, and this ties, of course, to that in terms of the impact, is the BOJ this week. Can they continue to hike the Bank of Japan in the current environment?
So it's a tough one because right now the inflation data, the wage data is actually quite supportive. We do not have a call for a hike this year in BOJ. The reason is because we think with the tariff volatility, there could be risks to the downside for inflation, especially if yen continues to appreciate. And so these are headwinds to inflation in Japan. And so for the second half of the year, we think that'll overcome some of the positive news flow that we've had recently and restrain them from hiking. But clearly it's a risk in Q4 given today's data. We just think that in a quarter's time, the data is going to soften a little bit to prevent that hike.
Before we let you go, back to the US. Does the US skirt a recession this year?
Yeah, we don't have U.S. in recession as our baseline call. Look, we have the U.S. consumer slowing down fairly materially once those price levels move up into tariffs, but we don't have a recession as our baseline. We think the U.S. can kind of stabilize, especially as the Fed starts cutting in 2026, because the real pivot point is going to be at the turn of the year. That's when the consumer is probably going to most feel the tariffs, and the Fed is going to have to be making tough decisions. And that's where we think the trough is, and then we kind of stabilize in the back half of 2026.
Okay, so look to the first part of next year for action from the Fed on a slightly softer consumer and maybe a slightly weaker labour market as well in the US as those inflation dynamics adjust. Rajeev, thank you very much indeed with the deep dive in terms of how to think about these central bank actions and, of course, the geopolitical impact as well on the inflation story. Rajeev Sibal, Morgan Stanley's senior global economist, of course, at Morgan Stanley. Coming up, what exactly is Israel's long-term mission in Iran? We'll get more analysis, of course, as the conflict continues in the region. Stay with us. This is Bloomberg. President Donald Trump arrives at the G7 meeting in Canada as the sparring conflict in the Middle East is set to test the unity of a forum already divided over trade and tariffs. Oliver Crook joins us now to talk us through the first big international summit of Trump's second term. Ollie, where do G7 leaders stand then on the conflict? How much unity essentially is there amongst the G7 when it comes to this conflict between Israel and Iran, and to what extent is that going to overshadow trade conversations that maybe others within that grouping would have wanted to have pursued in Canada?
Yeah, this may be a topic where there actually is some overlap among the G7 leaders. You know what I mean? I mean, we're talking a lot about this as a G6+1, right? The United States that basically stands in opposition to a lot of the sort of collective initiatives that the G7 has traditionally tried to put forward. And as a consequence, we're not really expecting to get a joint communique from this meeting of the G7 leaders. That being said, you know, as far as the sort of situation in the strikes of Israel and Iran and back in the other direction, there has been more or less seemingly consensus. And first of all, what everybody wants is de-escalation. They want to take some of the temperature out of the issues that we've been getting and trying to get to a diplomatic solution. That being said, there has been basically no criticism of the preemptive strike, as Israel puts it, on Iran by the Israelis. And basically everybody has said from the sort of Western leaders, whether it's Ursula von der Leyen, Friedrich Merz, Emmanuel Macron, their message has been very aligned. It's saying that basically Israel has the right to defend himself, that Europe will not stand for an Iran with a nuclear weapon, and that is sort of in some way sort of a tacit approval of what's been going on. As far as Europe is concerned, in terms of the conflict itself, I think it will bring to bear two things. The first is that it will show once again basically the Europe's limited influence in the absence of the United States to bring any effect to bear on Iran or the Israelis. Are going to be spectators likely once again on this conflict. But the second, Tom, and this is something that's I think worth resting on for just a moment here, this is the sort of last pillar of support of Russia in the Middle East after the fall of Bashar al-Assad. The Iranians, as they get weakened, what is bad for Iran will be seen as being bad for Russia from the Europeans, so they'll probably likely continue to accept what Israel is doing and actually welcome it in some regards, because it will diminish Russia's ability to exert influence and potentially strike in Ukraine.
OK, Bloomberg's Oliver Crook, thank you very much indeed on the potential consequences of this conflict for Europe and other members of the G7 as they meet in Canada, a summit, of course, we continue to cover for you. Now, as strikes on Iran intensify, Israel is looking to exploit the Islamic Republic's weaknesses in an effort to foment economic unrest. Joining us now with more analysis is Roxane Farmanfarmaian, lecturer at the University of Cambridge. Roxane, thank you for your time. It seems there is, at least on the edges, an aspiration amongst this Israeli government potentially to foment and see an end to the regime in Iran. That seems to be becoming slightly more explicit in the last 24 hours or so. What is your expectation of the weaknesses, the vulnerability of the Iranian regime at this point?
Well, I think so far we're seeing a rallying around the flag more than a sense that the population is not supporting the government. I think there is a distinct feeling that this is Israel's war. It is the one that attacked Iran. And although Iranian parliamentarians are already considering the withdrawal of the Nuclear Non-Proliferation Treaty, the NPT, there is less voices being raised to develop a bomb. They're saying they still follow the fatwa, if you will, of being against the development of a bomb. And they have said that if Israel stops, Iran will stop. So there's definitely a sense that this is being generated by Israel, and the Iranians themselves are not supporting a war and this kind of slugfest that we're seeing.
And to be clear then, Roxane, you don't expect to see large-scale public unrest in Iran that could pose a challenge to the regime, at least in the medium term, short to medium term?
Certainly in the short term. I mean, this could drag on for quite some time. And if it does, then, of course, there will be uprisings, perhaps, because of shortages, because of discomfort on the part of a population that will be suffering electricity shortages and this kind of thing. But at the moment, the feeling is very much that the country is under attack, and that many of the facilities that were originally described as not being at risk, so electrical infrastructure, the gas fields, for example, that these nonetheless are coming under Israeli strikes, and that is the feeling, therefore, in Iran is that this is attacking them as a people.
And the Iranian regime has long insisted that it is not pursuing a nuclear weapon, a nuclear bomb, that its nuclear capacities and facilities are for civilian use only. Does that assessment within the Iranian regime change as a result of this conflict? Do does this push Iran closer to that nuclear weapon?
Well, certainly the fact that Israel has attacked it is one of those classic cases where it's always said those with a bomb do not get attacked. And so that's the North Korea and Pakistan type of situation. And I think what we're seeing is that there is discussion in Parliament about that for the first time, and in serious terms, I mean. And so if anything, this Israeli attack could push Iran towards crossing that red line that has existed inside the country up until now of developing an actual weapon. But of course, it depends on how badly the nuclear facilities and refineries are hit by Israel. And unless the United States gets involved, it is very unlikely that the nuclear program would be decapitated so totally that it would be dysfunctional.
And on the subject of the US, it seems for now at least Iran has not targeted US bases in the region, though it has threatened to do so. Do you expect that to be maintained by the Iranian regime? They don't want to pull the US into this conflict. Is that your understanding?
I think the Iranians are playing a double game here in the effort to try to reduce the temperature. I think there's quite a bit of conversation between the Iranians and the region. They're very much watching the fact that the region is not getting involved, and the foreign minister al-Araghchi has said it does not want to see the region affected, that would be a completely a huge escalation, and that they would not want to be responsible for that. So on the one hand, I think they're hoping that there could be some kind of negotiation over the nuclear situation with the United States, which would then reduce the attacks by Israel. On the other hand, I think they feel a little bit entrapped by the U.S. One of the key reasons for the negotiations with the U.S. was to avoid an attack by the Israelis. And of course, that has not been avoided. And so partially one of the reasons for those negotiations is moot. On the other hand, I think they are trying to find some kind of way to attack Israel on a par for par without escalating the situation. And I don't think it's very clear what President Trump meant about a deal. I think the deal that is available is only with the U.S. because Israel and Iran are not in negotiating terms.
OK, Roxane Farmanfarmaian, thank you very much indeed. Lecturer at the University of Cambridge with that expertise and those insights, of course, into the region with a specific lens there on Iran and how it may be thinking about the steps ahead. We are at the Paris Air Show, meanwhile. We're going to switch focus where blockbuster jet deals are likely to be overshadowed by safety concerns following the fatal Air India crash. Guy Johnson is on the ground for us. More on that next. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. Hostilities between Israel and Iran enter a fourth day, stoking fears of a wider war in the Middle East. Oil prices waver and stocks stage a tentative rebound as investors temper their risk-off positioning. And President Trump lands in Canada ahead of the G7 leaders summit with tensions in the Middle East and global trade set to dominate. Now, despite global tariff threats and escalating geopolitical tensions, investors are still betting on emerging markets. EM currencies have had their best start to the year since 2009, and investors think there is room to rally further. We're joined now by Giulia Pellegrini, EM Portfolio Manager at Allianz Global Investors. Giulia, thank you for joining us around the desk this morning. So as we weigh up, of course, the Middle East tensions, we weigh up what happens in terms of global central banks with the BOJ and the Fed and the BOE this week. And then we cast a lens onto the EM space. Given that outperformance we've seen year to date, is there anything across that story that derails EM outperformance as we head into the back end of this year?
Well, of course, first of all, thanks for having me again on the show. It's interesting times, especially with geopolitics, as you pointed out in your opening statements around, of course, the escalation of tensions in the Middle East. Fourth day of conflict, tragic to see more loss of life in the region. And as EM investors, we're obviously watching it closely for the impact potentially on oil markets, but also on global risk sentiment. So we've seen the EM asset class performing very well this year. You've got EM hard currency bonds at over 4% return so far this year. Local currency touching 10%. Impressive story, really, since we haven't seen that in, as you said, a number of years. It can be derailed by an escalation in the Middle East. We are not seeing that. Of course, the permutations to that Middle East conflict are several. Should Iran, for example, escalate by closing the Strait of Hormuz, where about a fifth of the oil supply globally goes through every day, that would be a significant escalation for us, oil spiking probably above $100 a barrel. We are not seeing that at the moment in terms of the statements we're getting from the region. And most importantly, if you look at the EM side of the story, we've got a very resilient asset class we're talking about. And that's part of the reason why we're seeing these kind of returns this year. So, of course, U.S. exceptionalism, that whole narrative has been shelved. But we've also got a strong improvement in EM fundamentals with more rating upgrades than downgrades in the last 2 years. Half of the asset class being investment grade now. We've got reform stories from Brazil to Turkey to Nigeria to Pakistan, you name it. And, of course, we got central banks locally playing with a very nice cushion of real yields in the 6 to 8% region. That gives you a lot of room to maneuver as a local central bank.
There's a lot to unpack there and some really interesting points that I kind of want to unravel.
Sure.
I want to start on the hypothetical risk scenarios in the Middle East then, and then we'll move it on to some of those other fundamentals, which is dollar per barrel at 100 and above, or the Straits of Hormuz maybe being closed by Iran. Neither of those things are happening right now. But in the hypothetical scenario that they do, how do you change your view on EM? Which EMs are most vulnerable in that scenario?
Well, the asset class is roughly divided 50-50 in oil importers and oil exporters. You could see oil importers being particularly negatively affected, but a good chunk of the asset class that gives you a lot of room to play as an investor, also benefiting from higher oil prices. Of course, there's the second channel I mentioned, which is global risk sentiment. Undeniably, such an escalation would be seen as very negatively from markets. The concern around inflation picking up locally across Yemen, not only that. And so that would inevitably bring in more risk premium to the asset class. Provided that you can withstand those, you still have, as I said, a good half of the asset class to play with, particularly some of the oil importers, some of which, as I said, have also shown an impressive reform path over the past year or two. So there are stories to work with across the developing world.
What assumptions are you making about the direction of the US dollar as you push out your view on this EM outperformance story? Does the dollar have to continue to underperform to keep that story running?
I think that has definitely helped so far, and we think that EM currencies have effectively bottomed out cyclically against the US dollar. So we still see further room to run for these EM currencies. I think also, however, as I was saying, it's not just purely a story of the dollar and the end of US exceptionalism narrative that we were talking about just 6 months ago. I think there's a story of improving fundamentals, as I said, and really proactive central bankers that now have bought themselves the room to maneuver with real rates, in some cases in the 6 to 8% area, if you look at Brazil, South Africa, Mexico, Colombia. So you've got a lot of room to maneuver there to support your economy in the context of a global slowdown, perhaps even more so if oil prices increase, and also contain inflation, which is generally on a lower trend locally. All the while keeping an eye on your exchange rate so you avoid excessive volatility. So I think EM central bankers are in a particularly good position, which they have bought themselves by doing the good work over the last 2-3 years.
Okay, they've done the homework. What is the China story in that? I mean, you named some countries that are major trade partners with a China that still looks pretty vulnerable in terms of its economic trajectory, with the impact of tariffs, with a consumer that's not kicking into high gear, with that deflation story in China. Yeah. What does the China read across to some of that positive fundamental story when it comes to EM?
I think China is still one that we're watching closely. It's an economy that is stabilizing, but arguably still working towards changing or containing that deflationary effect that its economy is still seeing. And that is a battle that they're still fighting. To be fair, they haven't quite nailed. Having said that, that has a read across to many of the sort of South Asian and Southeast Asian economies that we invest in. They have yields locally in around the 6-7% area. These are still pretty solid yields to work with. They've got room to cut rates across the Thailands, the Philippines, the Indonesias. So there's something to play there with, especially in the context of, again, slowing down global growth because of also trade tariffs that we're seeing still in a flux. Yeah. We know that there'll be some more news come mid-July, but it's still in a flux.
So these EM central banks, they've got the space to be able to cut rates in that scenario. Is your base case that in 2026 we do get a slowdown that triggers those EM central bank rate cuts? Is that what you're pricing in for next year?
Well, there's certainly going to be a bit of a slowdown, undeniably, because some of the work is being done now and inflation will tick up inevitably, especially if we see some changes again in global geopolitics and the like. But we think there's still quite some time to get there before we see inflation picking up again around this time next year, perhaps, in some of those EM economies, a little bit earlier, only in a few cases. So there's still a lot of a runway to play with for investors globally. And we certainly see in terms of client flows as well. We've had a streak of 8 weeks of flows into EM local markets, which have effectively erased all the outflows we saw in the earlier part of the year. So end investors are clearly seeing this as well and moving their money accordingly, which in turn results into a virtuous cycle.
Where are those flows coming from?
Across the board, investors that look at the EM asset class. Yeah. Or
I'm just wondering if you're seeing pronounced moves out of the US. You talked about the end of US exceptionalism earlier.
Of course, yeah. I mean, what we're essentially saying is that investors are looking at alternatives to US assets, and they're seeing these very interesting markets that are showing better fundamentals, more proactive policymakers. They've already returned nearly 10% this year. What's there not to like? Let's try and diversify our portfolios, and that virtuous cycle for us is only just kicking in. Hence, we're saying, yes, of course, there may well be a slowdown into mid-next year, but there's still quite a lot of room to maneuver until then and a lot of returns to peak up for an EM investor.
Okay, that's the constructive case for EM, and you're leaving the door is open for investors to get further exposure to that space. Before we let you go, is there one or two EM markets that you steer clear of, despite the overall constructive view that you have on this space? Is there anything that you're more cautious on?
We obviously have different weights depending on the market, but there isn't something we're particularly negative on. There's varying degrees of exposure there. Some of the ones we like the most is South Africa, still Brazil, despite some lingering fiscal issues. You've got interesting potential in the Turkish lira still, despite the moves we've seen, and some geopolitical risk there, also very locally brewed, as we know. So the opportunities are there. Perhaps we're better disposed towards some Latin American EMEA stories versus Asian stories that we discussed, maybe more at the epicenter of that China trade discussion. But all in all, we are active investors. We like to be selective in what we do. So we refrain from this broad categorization, not this region, yes, that region.
Giulia, thank you very much indeed. Opportunities, particularly in South Africa, Brazil and Turkey. Giulia Pellegrini, EM Portfolio Manager at Allianz Global Investors, on the opportunities within the EM space in this current environment. Now, Brent crude is currently lower on the session, having been as much as 5.5% higher earlier. The market bracing, of course, for an escalation that could disrupt supply from a region that produces around a third of the world's crude. So far, we have not had that major disruption. Brent currently down 0.3%. Let's bring in Anthony De Paola, Bloomberg's Middle East energy reporter. So we've seen a bit of a turnaround then in terms of prices lower, Anthony, in the session today. What is underscoring that? Is it an expectation that maybe Iran doesn't look to throttle the Straits of Hormuz?
Yeah, I think that we saw that jump earlier this morning based basically on concern about what happened over the weekend when we did see the first strikes against energy infrastructure in Iran. And that's seen as kind of a bad sign that if they do start going after energy infrastructure in Iran, that potentially does cause interruption of supplies. Or potentially some tit-for-tat assaults by Iran on other production elsewhere in the Gulf. But that hasn't happened. What those attacks were over this weekend were attacks on mainly domestic oriented facilities in Iran. So we had an attack on an oil storage depot in Tehran, where that refinery supplies a lot of domestic fuel supply around the capital. We had an attack on a gas processing facility in the south, and the gas is mostly used for domestic use. So we're not seeing strikes yet on Iran's productive capacity or on Iran's main oil exports. So those are continuing to go to the market. And without that attack directly on Iran's main oil production and export facilities, then that seems to lessen the likelihood that Iran would try to interrupt the supplies of others. So we talk a lot about the vulnerabilities around the Strait of Hormuz. Iran doesn't necessarily have to close that fully in order to create some obstacles there. They could, as they have done before, arrest some vessels to try to bring them into Iranian waters and claim there was some kind of security issue or some kind of safety issue. So there's a lot of things that they could do. So far, none of that has happened. We haven't seen any moves around Hormuz. Obviously, some vessel owners have said they're reluctant to send their ships into Hormuz because of potential war risk. But we haven't seen yet any activities that affect any vessels or any flows. So we're not seeing that yet. And that's why we're seeing the oil price come off now, because the idea of that threat has been a little bit diminished now, Tom.
Anthony, OPEC Plus looking quite prescient now, given that they made that decision, of course, prior to this conflict starting, to add more barrels onto the market. Do we know if this changes the calculus going forward for OPEC Plus? Do they reassess their strategy in light of what is taking place in the Middle East now?
Yeah, for sure. I mean, they're going to be assessing the situation as it goes along in any case, because OPEC Plus is taking these month-by-month decisions now. So they've got another decision coming up, depending on when they put the meeting, either at the end of this month or the beginning of next month, in order to decide the coming policies. So we've seen increases by OPEC Plus of more than 400,000 barrels a day so far for the months through August. So we're possibly going to be looking to see more on top of that, depending on how OPEC assesses the market. Now, going into this, going into the current conflagration, what we saw was that the market was strong. Refining margins were holding up, and that was a lot of summer demand. OPEC thought they could bring more oil into the market because they didn't see oil building up in storage and stockpiles. So they thought they had some room to bring some in. But then the prospect for later in the year, for the second half, was that we would see a weaker market, and that OPEC would have to then evaluate whether they do continue with those increases or whether they do decrease. So now they'll be looking to see, what are the interruptions? Is there still that demand? Or are people scared off of economic activity because of this issue, and demand decreases? So they're going to be looking at those issues, the underlying demand plus any potential interruptions before they decide, and as they decide to make that choice of whether to continue at the pace of 400,000 barrels, even perhaps putting more on the market, because they do still have more spare capacity. The issue is, getting that to market and making that decision. So we'll definitely be watching that, as they will be watching the situation in the market, Tom.
OK, excellent update. Thank you. Bloomberg's Anthony De Paola in Dubai with the line, of course, that OPEC Plus has that additional capacity. They will be watching this closely. WTI currently trading just below $73 a barrel, down 0.2%. Now, switching focus to what is happening in terms of the aircraft industry and what's happening on the ground in Paris. Airbus Chief Executive Guillaume Faury says it is an uncertain world with pressures on aircraft deliveries, trade tensions and conflicts around the world. Take a listen.
We have plenty of contradictions to manage. We have a very strong backlog of signed contracts, customers expecting those aircraft to be delivered, so we have pressure on deliveries. We have a challenging situation for supply chain coming out of COVID, now with the uncertainties on trade and also on conflicts around the world. So we're pushing hard to be able to fulfill our obligations to our customers. They count on us, but it's an uncertain world.
And Faury was speaking exclusively to Guy Johnson at the Paris Air Show. And Guy joins me now. He's been on the ground, of course, through the day. How are tariffs weighing on the aviation sector then, Guy? This is a question, of course, you put to executives on the ground where they continue to wrestle with the tariff impact.
Tom, tariffs are just one of the challenges these guys are facing right now. This was an industry that was already facing problems from the supply chains that came out of COVID. They never really recovered from that. Then you put tariffs on top of what we're dealing with here. You put a changing foreign exchange story on top of it. You put what is happening in the Middle East, what has just happened with the Air India flight. This is a hugely challenging environment at the moment, not only on the ability to supply new aircraft, but the ability to put those aircraft to work. The tariffs are going to cause all kinds of problems with that. How do you get aircraft into Europe? How do you get them into the United States? Many of the people in this industry simply don't have the answers at the moment because we don't know what the tariff picture is going to look like. But tariffs are just one of the challenges that the industry is facing. We need clarity from the Trump administration on what is going to be happening. The July deadline is coming rapidly towards us on the 9th. At the moment, remember that tariffs do apply. We've got 10% tariffs on, for instance, Airbus aircraft going into the United States. Now, there's ways around this, but whether or not those last for much longer, we remain to have that question answered. So, yeah, I think I can't remember an air show, Tom, when you had more complicated factors, both on the demand side for aircraft and the ability to supply aircraft. Tariffs are but just one of those factors that we have to roll into the mix.
Yeah, and Faury really articulated that, didn't he, in that interview that you had, of course, with the CEO. Guy, what else are you expecting from the show, given all of those complexities, all of those issues facing this sector?
Yeah. Well, I think you're probably going to see a slightly quieter show, to be honest, Tom. Kelly Ortberg, who is the CEO of Boeing, is not here. A number of the Middle East airline CEOs are not here. They are not showing up because they're watching what is happening, obviously, with the evolving security situation in the Gulf, the ability to manage airspace in the Middle East at the moment, hugely challenging. Kelly Ortberg is not here because of what happened in India. So I think you're probably going to see a slightly lower intensity show as a result of that. I think some of the Middle East carriers that were going to be announcing big orders, maybe they push those to the right and announce some of those orders a little bit later. There's all kinds of theories going around the show about what happened to that Air India aircraft, so people are certainly talking about that. But from a normal kind of razzmatazz point of view, billions of orders are being placed here. I think you're going to see a much quieter situation, and certainly there are many fewer CEOs here than you would normally anticipate. Now, some of that's simply down to what is happening with the day-to-day operations of carriers that are struggling to make their operations work in the Middle East. The other is what is happening with the Airbus story. But even those that are here are certainly being quieter than they normally would. So I think probably a more subdued situation. This is an industry that gets impacted by so many things. Consumer demand. You were just talking about the oil price story. That's another factor you've got to throw into the mix as well. Then there's a big defence story here as well that you've got to bear in mind as well. The French Prime Minister was here. Emmanuel Macron's at the G7 right now. He's going to be coming here on Friday. So that maybe comes to the fore a little bit more as maybe the civil side takes a back step because of some of the situations we've already outlined, Tom.
Bloomberg's Guy Johnson. Great stuff on the ground for us in Paris at the Paris Air Show. Of course, plenty more coming through from that show throughout the next few days. Now, Bloomberg has learned that Gucci-owned Kering is set to name a Renault head Luca De Meo as its next CEO. Charlie Wells is here with the details. Major change at the top then for Renault and Kering. Charlie, talk to us about what we know, what led to the change at the top, particularly for Kering, given the challenges it's faced.
A pivot for De Meo, really kind of shifting out of the highways of Renault to the runways of the fashion industry with Kering. And De Meo really is an executive who's known as something of a turnaround expert. If you take a look at the share price of Renault versus Kering over the past 5 years, you can really see under his tenure, really that share price doubling during the period when he really kind of helped take this company out of some of the depths of COVID. We're launching new products, getting into new partnerships with a number of firms that consumers and investors like. It's a different story for Kering over the past 5 years. You really have seen that company struggling in that ultra-competitive luxury space. But this morning, on the back of this announcement, if you take a look at the markets, you see a flip of that narrative. You see Kering, the best performer in the Euro Stoxx 600, their share price getting a significant lift on this news, whereas Renault really struggling, the worst performer in that index, as analysts have been releasing notes about the strategic direction that Renault might take with De Meo gone. But just because we're seeing this lift this morning does not mean that that De Maio has an easy ride when he gets to Kering. If you take a look at the revenue sources that this company has, 44% coming from Gucci. Gucci is a brand that has really struggled on some softness out of China, has struggled to navigate some of the shifts in the fashion industry regarding trends. So when De Maio arrives at Kering, he might want to think about buckling up.
Okay, Charlie Wells, very nice. Thank you very much indeed. With change, of course, at the top of Kering, which has seen that share price pressure down 80% since 2021. Can Luca De Maio turn things around? Coming up, our exclusive interview with the Prime Minister of Luxembourg, Luc Frieden. We're going to talk trade and geopolitics. That is next. This is Bloomberg. The G7 summit is underway in Canada. The EU trade chief is attending the gathering, of course, seeking progress in negotiations with the US ahead of a July the 9th deadline. Geopolitics also high on the agenda. Plenty to discuss then with the Prime Minister of Luxembourg, Luc Frieden, who joins me on set right now. Prime Minister, thank you very much for your time. I want to start on the issue of the moment, which is the Middle East and the impact that's having on oil prices. The EU is considering further sanctions on Russian oil, potentially moving the price cap from $60 to $45. Given the recent increases in oil prices globally as a result of what's happening in the Middle East, does that have to be sidelined, that proposal?
No, we have to look at all these things together because diplomacy must prevail. At the same time, we need sanctions against those who do not comply with international law. And therefore, I support all measures that sanction Russia, because Russia is the aggressor. At the same time, we need to make sure that we get a ceasefire in all the conflicts and we work on lasting peace. And therefore, I'm in favor of more diplomacy and less violence because of the escalation that entails, with all the consequences on oil prices, but moreover on the general stability in the world. So I'm very concerned about what's going on in Gaza, in Iran, Israel, in Ukraine, and we should not forget one of these conflicts.
On trade, we are counting down to that July the 9th deadline. If the US decides to impose additional tariffs on Europe, what should the response be from Brussels?
I believe that in the long term, we need to have a good relationship with the United States, independent of temporary events that take place in the US. So I think let's work for a sustainable, negotiated agreement with the United States. And I'm hopeful that we can achieve that. I think that we have to do with an administration in the US who is trying to push us against the wall. But at the same time, these are our friends, long-standing friends. And therefore, I'm confident that also at the G7 and thereafter, we can find a basis for the US to be and to continue to be a partner in security issues. And we discuss it at NATO and on trade relations. Let's not look at the short term. Let's focus on the medium and long term in our relations with
As
the
that
US.
friend of ours pushes us against the wall and pulls back on areas like defence, there have to be new revenue streams for Europe to fund that defence, to fund that infrastructure.
Yeah.
Would you be open to joint debt along the lines that we had during the pandemic to fund that?
If it is focused on defence, which is a huge issue, if it is focused on specific items such as also the green transition, yes. Then
you're in favour of joint debt for defence and for the green transition?
Yes, because I think this is a common challenge. There's a common challenge that no country on its own can shoulder, especially now that we are increasing our defence expenditures.
OK, Prime Minister, we've run short on time, but we really appreciate you coming into the studio and giving your thoughts on what is happening, of course, when it comes to the question of trade and the need to fund defence and infrastructure in the EU. Luc Frieden, Prime Minister of Luxembourg, joining us in the studio. There's plenty more coming up. Stay with us. Bloomberg Brief is next. This is Bloomberg.